Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. So glad to be joined once again by Brent Johnson of Santiago Capital. Brent is an asset manager who focuses a lot on the power of the dollar, and he is well known for his role of viewing the dollar as a risk-off hedge, which he thinks is underrated, and I think he's got a lot of compelling reasons why, as well as the view that he has the temerity to say that the global dollar system may last for one more week or 2 more weeks or even 5 years, which, we all know the dollar system is about to collapse. Anyway, Brent, great to see you. How are you doing, my friend?
I'm good. Thanks for having me back. It's been a while since we spoke.
It's been so long. To frame the conversation and to put a pin on it for the audience, we're recording the just afternoon of Friday, August 2nd. This morning, the market had a little bit of a shock with the very, very negative labor market. Unemployment rate ticked up from 4.1% to 4.3%. And so stocks are selling off like crazy. Of course, it can always get crazier. And interest rates are collapsing. The market is now pricing a 50% chance that the Fed does 2 double cut in September, double cut in November, which to me seems a little extreme, as well as pricing something like a 70% chance. Again, we record at 12:04 p.m. that the Fed just does a double cut in September. So things are getting a little topsy-turvy out there. Brent, how are you thinking about this market?
Well, I think this is the time when you look at your portfolio and hopefully you bought insurance when it was cheap, because it's no longer cheap. And what's been kind of interesting to me so far is that while the market pullback has been, I don't know, I wouldn't say it's been too dramatic, but it's been hard. It's not really the result of some crisis somewhere. It's really just a valuation reset. I think for the most part, the reason people are feeling pain is because they felt so good over the last, I don't know, call it 4, 5, 6 months or even longer. And I would characterize the pullback that we're having now as really just kind of a routine pullback. Now, the question becomes, does it become something more than routine, right? But so far, I think it's been fairly orderly. And again, while some of the moves have been big, especially in technology, you have to remember that the moves higher were very big as well. And so if you look around at other indicators, high yield seems to be doing okay. Bonds are rallying, treasuries are rallying on kind of a risk off sentiment, but we haven't seen a big blow up in anything yet. So in my opinion, what we're seeing now is the beginnings of a valuation reset. And the question is, what happens from here? Again, so far, we've got the dollar falling because they're expecting lower interest rates now. The other part of it that I think is contributing to this is that what's going on in Japan. The Bank of Japan has raised rates, and that has made the yen rally from 160 to 148 or whatever it is. Now, I think if a couple of years ago, if you had said the yen was at 148, people say, "Holy cow, that's horrible." But when when it's come from 160 to 148 in a matter of weeks, that's a pretty dramatic move. And what that means, Jack, is that those who are using the yen carry trade to make investments around the world are potentially now getting that liquidity pulled away from them. And as a result, then they have to sell those positions that they bought with that cheap funding. And so really what you get is potentially a rug pull on global liquidity. And because the yen carry trade is so large, with the yen rallying and people trying to figure out whether or not the Bank of Japan has staying power, whether they will continue this or not. In the meantime, they may not even be making the sell decisions. The margin clerks may be making the sell decisions. So I think we're getting kind of a combination of all these things, right? And then not to mention the fact what's going on politically in the US, what's going on militarily in the Middle East, what's going on diplomatically between the United States, Russia, and China. It's just, the calm before the storm was very calm, and now the storm is starting to pick up a little bit.
And earlier you said that hedges used to be cheap. They've gotten a little bit more expensive. One hedge, and I think of you thinking about this, one cheap hedge is the dollar, that in times of true crises, the dollar tends to actually rally against other currencies as those currencies struggle to be able to maintain their dollar funding. But it takes a real crisis, 2020, 2008, We are definitely not there yet. What is going to take for us to have that kind of moment? Because right now, as you said, we're in the time where the market today is definitely a risk off day. Gold is rallying, stocks are selling off, interest rates are collapsing. But as you said, the dollar is also rallying. So do you think we're in a regime now where actually the dollar could sell off alongside risk assets because it is the strengthening yen that is causing this global carry trade to unwind?
Part of the reason the dollar has been kind of flat recently is largely due, and even down a little bit, is largely due to the yen rally, right? Now, the dollar has taken a big move down today. That is primarily due to the bad non-farm payrolls number, accompanied with Powell's comments from a few days ago that, if they continue to see softening in the economy, then rate cuts are on board. And so now now the market's very much expecting rate cuts and perhaps, one or two double rate cuts. And so as a result, if you just use interest rate parity, then the dollar is falling. But if we get into a situation where this is no longer just a valuation change, and this is some kind of a crisis or develops into a crisis or some kind of a geopolitical event, I would expect to see the dollar rally significantly on that. Again, so far it's been fairly ordinary, even though the change in prices has been somewhat dramatic. You have to remember that they were dramatic to the upside before this. So the move to the upside was very dramatic. The pullback has been painful, but still, the market's still positive for the year. Right now, it may not be for very much longer, but so far it is. One thing you mentioned, gold. Gold's really interesting because when I came in this morning, and especially after the non-farm payrolls, gold was up quite a bit, but it's turned around and pulled back $40 from its high this morning. So I'm interested to see how that closes the week.
Are you bullish on the dollar right now? I mean, that's kind of like asking the Cookie Monster if he likes cookies. But,
I mean, in general, yes. But if somebody says to me the dollar could easily go to 95 if the Fed dramatically cuts rates, and I would say, of course it can.
Mm-hmm.
Of course it can. I even though I'm known for, my dollar bullish views, it's more of a medium term view. From day to day, week to week, who knows what goes on in markets? There's many moves that can take. But those who continually talk about the death of the dollar or the end of the dollar or the rise of the BRICS or the change of the monetary system, that's only going to happen through dollar strength. That's not going to happen through dollar weakness. As the dollar gets weaker, the rest of the world will just take on more dollar debt as they always have. The dollar falling actually is what keeps the system going. It's when the dollar goes higher that things start to break. And so, if we get into some kind of a crisis, I would expect the dollar to go higher. And here's the thing is it kind of makes sense, right? If the dollar underlies the global economy, and it currently does, and I know there's a lot of people who are saying that is changing, but as of right now today, the dollar underlies the global economy. Well, how can asset prices fall if the underlying currency is falling as well? In other words, if there's a liquidity crisis and people are scrambling for liquidity, and that's why they're selling securities, well, then whatever they're scrambling for typically rises in price. And right now, that's the dollar. So if we get into a situation that's a liquidity squeeze, then the dollar will rise. But as of right now, like I said, I think right now we're just in a valuation reset. Now, I think it's very possible that this transforms into a liquidity crisis, but I don't think we're there today.
Brent, there's a common perception of the rest of the world is the lender to the US dollar. Back in the days of the 1920s, the US had a huge trade surplus, 1910s and 1920s, huge trade surplus, and it exported those dollars to the rest of the world via loan. So US was always lending money to Europe, and they'd always have to have these conferences about who in America is going to, bail out some European country this time around. Now it's the other way around, where the U.S. has a massive capital surplus, where the rest of the world is an investor in the U.S. and the rest of the world buys U.S. Treasury debt, and so that is literally true. But do you think people sometimes miss something when they use the language that as if like the U.S. is funded by the rest of the world, and the rest of the world could just pull the money away, and the U.S. interest rates will rise, and the U.S. won't be able to fund itself? Do you think sometimes people, make a mistake when they use such language?
Well, I absolutely do. And the first thing I'll say is imagine the rest of the world wasn't buying our debt. Imagine if the rest of the world didn't want to invest in the United States. I mean, people will often say, we are reliant on the rest of the world. No, the rest of the world is reliant on the US economy for growth and income and safety. And again, you have to remember that this is a relative game. I'm not saying there isn't problems in the United States. There are huge problems in the United States. And I will often see these fantastic, reviews or analysis on the overall United States economy, interest rates, level of debt. And the conclusion is that the United States is very overextended and hard times are ahead. And as a result, you should get out of the United States and get out of the dollar. And the thing is if you analyze the United States in isolation, that is basically the only conclusion that you can come to. The problem is that analyzing the United States in isolation is not a fruitful endeavor because it's a relative world. And if you do the same level of analysis that everybody tends to do on the United States, on Europe or Asia or South America or Australia or Canada, you largely come to the same conclusion. And at some point, unless you're an individual who has the ability to kind of check out, move to a mountaintop and come back in 10 years, you have to put your money somewhere. The big asset allocators that move capital on the global stage will put their money somewhere. So it is not an absolute game, it's a relative game. And so that is why the world seeks out the United States. Again, look at today. How many times have we heard over the last year, 2 years, 10 years, who is going to buy the United States debt? But now that we have a little bit of uncertainty in the market, what are Treasury yields doing? They're rallying like crazy, or bonds are rallying like crazy, and interest rates are falling. Now, that's not the Fed doing that. I mean, don't get me wrong, the Fed might be in there in some form or another, but this is market action right now, right? That we're not in a period of QE. And so, I think people kind of get it mixed up when they're an analyst. Let me say it this way. It is a little bit different when you analyze the country and the currency that is the global hegemon and the global reserve currency. Doesn't mean that it's always different on all cases, but in some cases it is different. And one example is that the way the monetary system works is that on the large, again, if we go back to these large asset allocators, the banks, the financial institutions, the endowments, the hedge funds, they buy treasury bonds, they post them as collateral, and then they get close to 100% leverage on it. That's the way the system works. The system is one of collateral and leverage. You might not like that that's how the system is, but that's how the system is. And so if for no other reason, the rest of the world will buy US Treasuries because they get, what do they get? 98, 99% leverage against them. It's almost just like holding cash, right? And it's not, and I know there's people out there saying it's not like holding cash, the bonds can lose. Yes, of course, you are right. I'm just saying that this is how it often works. And so if you're choosing between buying a US sovereign bond and a Turkish sovereign bond, or an Argentinian sovereign bond, or a Philippine sovereign bond, or even a Japanese sovereign bond, you get preferential treatment for buying US Treasuries. It's just the way the system works.
Forward guidance is brought to you by VanEck. The VanEck Morningstar-wide MOAT ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? MOAT strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/MOATFG to learn more. That's vaneck.com/MOATFG. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide MOAT ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, let's get back to the interview. And it's like a US Treasury bond versus a Turkish bond. It's like Apple versus some regional bank stock that no one's ever heard of. It's like Apple, it might be a bubble, whatever, but everyone's in Apple, so you can get in and get out frequently, and liquidity begets liquidity. And no one really wants a Turkish bond. Sorry.
Yeah. And to that point, and I think this is extremely important for people to understand. Again, yields are falling today, but over the last couple of years, they've been rising and they've been high, especially maybe not in long-term historical terms, but high versus the last 10 years, certainly, right? And the high rates that the US has been paying is, every day you open up the newspaper or you go on Google or you go on Twitter and it's the United States now has a funding problem because interest rates are so high and they have to roll over all this debt. And this is a nightmare for the United States. Now, again, if you analyze the United States in a vacuum, that's not a horrible conclusion to come to. But what you have to realize is take into context what I said before about the world uses treasuries to operate. Now, if a US Treasury is having higher yields, let's just say 4.5% to 5% or 4 to 5%. This is a nightmare, not just for the United States or not for it's a nightmare for the rest of the world who is competing for funding. Because if the US is going to pay 4 or 5%, then another entity has to pay a heck of a lot more than 4 or 5% to attract liquidity. Because all things being equal, you're going to buy the thing that underlies the entire system. So US Treasury yields going to 5, or let's say it goes to 6 or 7%. That is a nightmare for emerging markets, because now emerging markets who typically have to compete very strongly for liquidity in the first place are now going to, if the US Treasury is offering 7, what are you going to make Egypt pay or Turkey pay or the Philippines pay or Thailand pay or whatever it is in order to buy their sovereign bonds? So higher yields in the US actually draw more capital to it, or at least make others have to pay a higher yield as well. And I think that's what many people forget, that higher rates are not just a problem for the United States. Higher rates are a nightmare for the rest of the world.
And the Federal Reserve is in the driver's seat. Now, economic conditions, of course, are growth and inflation and employment are really controlling the Fed's actions, but the Fed is in the driver's seat of US dollar interest rates, and US dollar interest rates are what control a lot of the global interest rate matrix. Earlier, you referenced interest rate parity or covered interest parity. And that theory is basically, as interest rates rise in currency A, money is going to flood into currency A and cause it to appreciate. Or there's going to have to be like a forward markets currency B is going to have to be, appreciation is going to have to be priced in the future. And that makes a total sense, that theory that you just explained. But what the argument that you said you disagree with about who is going to buy the treasury debt, I think the underlying case there is, as interest rates rise, the US has to pay a greater and greater interest expense. So the deficit gets bigger, so the debt gets bigger, and so that gets more unsustainable. What do you say about the so-called fiscal doom loop, that as interest rates rise, interest expense rises, and it's the US is screwed?
So I agree with it. Again, this can't continue forever. But, you and I have talked about my dollar milkshake theory on several occasions, right? And essentially what this says, and again, I'd have to go back and look, but I think the very first time I ever spoke about it publicly, I think the very first sentence was, "This is a story that ends very, very badly."
Mm-hmm.
And I agree with that. This will end badly, but based on the design of the system, nothing is certain, right? Nothing is ever certain, but the probabilities based on the design of the system is that the United States will fall last. And if you are in a relative game, and here, if you don't want to play the game, then don't. But if you do play the game, which I do, this is my job. I actually like the job. It's crazy. It's frustrating. It's fascinating. It's like the Super Bowl, but I like to play the game, right? And if you are playing the game, there is going to be an end to the game. The game will end, right? But you've got 4 quarters and potentially overtime before that happens.
And likely, honestly, I mean, the investor's life will end before the game ends, honestly, right?
Very, very possibly or probably, right? Yeah. And so if you understand the rules of the game, and if you understand that in many ways the United States can change the rules of the game if they choose to, the probabilities are extremely high that the US falls last. Now, is it impossible for the US to fall before being the last? It's possible. but that's a low probability event. And investing is all about banking on the probabilities. I don't really have a problem with people who come up with these theories of, the dollar's going to do this, or the US is going to do that, or Russia's going to do this, and the BRICS are going to launch that. It's fine to think about these possibilities. It's fun, it's interesting, and it's important to understand what could potentially happen. The problem I have is when people will come up with these somewhat out there theories and then assign a 99% probability to it. And they'll speak about it with such certain terms that I feel like people who aren't as educated will listen to these people and say, oh yeah, that sounds really good. Well, take a step back and realize that many of these theories, about the US's impending doom loop have been around for 30, 40, 50 years.
And have been espoused by some of the best educated economists in the world, and they've been wrong.
Yeah. I mean, I can literally remember, and I joke about this every now and then on Twitter, but it's actually true. I can remember being 10 or 12 years old, just starting to kind of understand how the world works and reading this newsletter that my dad had. And it was talking about, and at the time, this was like the early 80s, my dad had bought a bunch of silver because of this potentially impending doom, right? And it was talking about how this was unsustainable and couldn't keep going. Now that's literally 40 years ago, right? So it's not that they're wrong. It's just that imminent and inevitable are two completely different things.
You're so right. And you said even people might not be wrong. They're just early. I would say being early is the same as being wrong. And people who thought there'd be a recession in 2022, and by the way, I found that argument convincing. The fact we may have a recession now or maybe about to enter one, given we had a horrible jobs report today, it's like you weren't right in 2022. You were wrong. And now maybe you're right. But if in 1990 you think there's going to be a global credit crisis and it finally happens in 2008, you weren't right. Well,
especially in my business. Now listen, my job is to manage people's money. Now, managing money is light years different from writing research or selling signals. It's dramatically different than teaching finance. It's dramatically different than being an economist, right? Because it just is. Like, we are measured on sometimes a monthly, quarterly, yearly basis. And to a certain extent, depending on what type of clients you have, you can have a longer term time frame. Maybe some clients will look at a 2 or 3 year time frame or a 5-year time frame. But when you are managing capital, timing matters much more so than if you're writing a newsletter or putting out research. And listen, I'm not bad mouthing those other professions. Those are very legitimate, important, worthy endeavors. They're just different than managing capital. And from a managing capital perspective, timing does matter. Now, I'll give you an example, and because I certainly don't get this right all the time. When I started talking about this dollar milkshake theory, it was 2018. It was kind of the middle of 2018, and I really started talking about it more in 2019. And what I was saying was that the table is set for a currency crisis as a result of all the imbalances. And when we get into a currency crisis and a debt crisis, the dollar will outperform. Now, that was 5 years ago, Jack, and it hasn't happened yet. Now, we sort of had it in 2020, and I would argue that in many ways, COVID was such a severe thing that it kicked the can down the road, at least a couple of years. But I still think that we will have it. But when we did that, when I started talking about that, we set up a fund to take advantage of this. But because we knew that we could be wrong, and because we knew that one of the most obvious ways we could be wrong was timing, what we did is we set up a fund that had very asymmetric return characteristics, and we told people don't put more than 5% of your portfolio in it, right? Because if timing doesn't pay off, we're going to lose all that money. Mm-hmm. But if we're wrong and the 5% goes down, then the other 95% of your portfolio that's in traditional assets is going to do very well. And that's exactly what has happened, right? That's exactly what's played out. COVID came along. We had some very asymmetric returns to the upside very early on, but then those asymmetric returns fell because traditional assets did well, and the rest of client portfolios appreciated very well. Now, I continue to think it's important to have, some kind of insurance protection for the downside. I think that what we've largely seen for the last 4 years will not likely happen over the next 4 years. I think the average level of the VIX over the last 4 years has been something like 17, 18. I would expect that to be higher over the next 4 years. But again, who knows? But the point is in all of this stuff, it's a matter of probabilities. And when you put capital on the line, if you're going to, you don't put 70% of your portfolio on a hunch, right? Or you don't put 80% of your portfolio on a thesis that's been out there for literally 40 years and hasn't happened. So, again, part of my interest in talking about this so much, and again, pounding the table on it, is not to get people to change their mind, not to convince people that I'm right, but just to get them to think a little bit. And perhaps they don't have everything figured out to the extent that they think they do.
Absolutely. And just on the point of the hedge, the ETF that trades in short-term VIX futures, right now is trading for $36. In October 2011, it was worth $88.26 billion. So it's definitely, the fund was not that big now, but that fund is down 99.9999%. And so it really is a very bad hedge. It's great in that it has very convex performance, but its absolute return profile is very negative over time. Is that part of the reason why you're attracted to the dollar as a hedge, that it's just it bleeds less?
Perhaps there's a misperception here. I don't think people should just go out and buy the dollar or buy calls on the DXY or UUP or whatever it is. The whole dollar milkshake theory is not about investing in the dollar. What it's about is understanding the knock-on effects of the dollar getting stronger. What happens in a world where the DXY goes to 120 or 130 or 140? What would that entail, right? I think it's pretty easy to understand what would entail if the dollar goes from 104 to 80, right? It's probably risk on, assets are rising, perhaps it's dramatically inflationary, right? That's a world that we're relatively familiar with. We're not familiar with a world where the dollar goes from 104 to 144. And I think many people misunderstand the ramifications of the Fed losing control. Again, the dollar falling is the Fed staying in control. The dollar, that perpetuates the system. If the dollar just kind of goes sideways in a band or falls in general, that perpetuates the system. The Fed losing control is the dollar going to 125 or 135 or God forbid 170, because that's when things start to break, right? And I think there are many people out there, really smart, intelligent, well-intentioned people who have made a lot of money in their careers who just don't think that is possible. And maybe they're right. Maybe it's not possible. But I think you have to plan for it, because again, thinking otherwise is thinking that the central banks will be able to manage our way out of their way out of this mess that we've gotten into. But my argument is that they will lose control eventually. But in other countries will lose control before the US. But when countries lose control, that will see the dollar rise, not fall. Now, if I'm wrong and the dollar falls, I'll be fine. I'm prepared for that. But I think I'm more prepared for the dollar to fall than most people are for the dollar to rise. And I think that's why I have wanted to express my understanding of how the system works so much, because I think the dollar is going to die. It's going to go through hyperinflation. It just can't last. It's like Helen of Troy. It's a theme that launched 1,000 newsletters, right? It's such a fantastic story that it always sells. But that is, in my opinion, one of the least likely things to happen. So I think the perception of the future of the dollar is completely wrong. And when you can invest a small amount of money on a perception that is widely held that is wrong, that small amount of money has the potential to be a lot of money. And the great thing about it is if you're wrong, that small amount of your money you bet doesn't kill you.
And so you said it's not about buying calls on the DXY, the US dollar index, But is it about investing a small amount of money in extremely out of the money calls that do price that DXY, which is now at 103 and peaked in 2022 in about 113, of going to 120 and 130? And by the way, it appeared in March of 2020 that the dollar was headed that way. The Federal Reserve stepped in and other things happened and everything turned out to be okay. The Fed extended swap lines. But just to understand the strategy, is the tail risk hedge, because you said it's not about buying calls on the dollar, but is it about buying extremely convex positions of the dollar, or is it about what happens to the rest of the world, to the stock market, if the dollar goes to 160?
Well, making a bet directly on the dollar is one way you could. Well, first of all, I'm going to take a step back here. 99% of my business is managing traditional assets, right? But understanding what the dollar is going to do helps me understand how to manage that 99% or 95% of a portfolio. We only have a very small percent of a portfolio that's allocated to these asymmetric ideas. So I don't want people to think that my entire business is based on these asymmetric ideas. But if you do want to have some kind of hedges or protection that will protect against an adverse market scenario, I think taking a small amount of money and betting on asymmetric opportunities is a fantastic way to go. One way is you can just do it directly and buy calls on the DXY or UUP or whatever it is. The other thing you could do is understand that if the dollar gets stronger, what does that do to other currencies? One of our biggest positions in our asymmetric allocation is puts on the Hong Kong dollar. We think that if we get into a global currency crisis or a debt crisis, it becomes increasingly likely that the Hong Kong dollar peg breaks. Now that hasn't happened so far, and perhaps it won't, but you can do that trade, and it gives you 500, 600, 700 times leverage. So you can put a very small amount of money down and get a huge leverage that if it happens, it has the potential to be life-changing.
That's because, I'm just looking, I'm shocked it's been this long. Since 1988, the Hong Kong dollar has been in a range between $7.70 and $7.85. So implied volatility I'm sure is incredibly cheap. So if you buy an option that even goes down a little bit versus the dollar out of that range, it pays off immensely. That's what you're saying.
Exactly. And again, and if you're wrong and it doesn't, well, you've lost a very small percent of your portfolio. And by the way, that it's a managed currency. The reason it has stayed flat for all those years with very low implied volatility is there's a currency board that keeps it there. But you have to realize in times of stress, it becomes increasingly difficult for them to keep it there. Many people know about the story of George Soros and Druckenmiller breaking the Bank of England, right? That was a case where the Bank of England was committed to a certain level, and these guys figured out that they couldn't keep it, right? And they could put on a brave face, but eventually they would have to cave, and that's exactly what happened. And they became legends as a result. So again, I don't think that people should go out and put 60% of their portfolio in puts on the Hong Kong dollar. If you put 0.6%, not even 1%, 0.6%, and you're wrong, you lost 0.6%. I'm pretty sure people have lost more than 0.6% of their portfolio over the last 2 weeks, right?
They've done it today, definitely.
Right. And so the point is that if you're wrong, it doesn't kill you. Does it annoy you? Does it hurt? Sure. But it doesn't kill you. But if and when it pays off, it changes everything. Now, and that's just one example. Another thing you could do is, you could look at what happens to different asset classes around the world. Again, if currencies start moving and the dollar starts rising, what does that do to certain commodities? What does it do to housing? What does it do to equity prices? My argument has been that equities around the world will suffer dramatically, but over time, U.S. equities will actually do very well. That's what's interesting about this, Jack, is that everybody said that as the U.S. raised interest rates, it would cause markets to crash in the United States. My thesis was that this is, again, I go back to Druckenmiller and Soros. They had a thesis called the Imperial Circle that said if you have higher interest rates and a government who is spending a lot of money in a desirable economy, that can lead to a boom. And it can draw capital from around the world in because of the higher rates. The government spending can be stimulative. And then you get a combination of wild animal spirits on top of that, and you can get much higher equity prices. And again, if I go back to my very first interview when I talked about this dollar milkshake theory, I referenced that phenomenon. And I said in the years ahead, I thought what would happen is that bond prices would fall in the US, interest rates would rise, the dollar would rise, and yet equity prices would go higher. And that's exactly what we've seen. What I also said in that same interview was that there will be terrifying drawdowns along the way, because that's what happens when the dollar rises versus foreign currencies. That's what causes liquidity crises and then dramatic pull downs. And I think that's what we're seeing now. I think we'll probably have, I don't know, a couple months, maybe 6 months worth of volatility to the downside in US equities. But I expect after that's over, US equities will go to even greater heights than they've already gone to. Because I think that's what will happen as the world seeks out safety and yield. So it's that's a way to understand the types of things that can happen with the dollar. And again, the reason that I focus on the dollar is it is what underlies the entire global economy. If you get the direction of the dollar wrong, it's very hard to have your portfolio do well. It's not impossible, but if you understanding what the dollar will do will dramatically help you understand what's going on in the world. And this is what I'll say is, even though the whole dollar milkshake theory hasn't played out to its conclusion, the dynamics that I thought would play out as a result of dollar strength have largely played out. And so even though I'm not 100% right, I'm certainly not been 100% wrong. And it's allowed me a level of clarity and peace during a time period that, I certainly, 2020 and, over the last couple of weeks has caused many people a lot of angst. I feel like I have a fairly good understanding of what's happening and why, and I'm prepared for what happens going forward.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course, the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today, and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10, stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Vance Spencer's going to be there. Jim Bianco's going to be there. VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. So as the dollar rises, a gentle rise, you could say, U.S. stock market is going to perform well. Is that in local currency terms, i.e. dollar terms, or is it just because the dollar is strong against the world? So, a European investor investing in American stocks, if the dollar squeezes hard, the U.S. stock market will be down slightly in dollar terms, but the European investor will be thrilled because their exposure is in dollars.
Well, I think it's both. I think it will ultimately rise in dollar terms, but I think it will rise even more in foreign currency terms. And this is, the other part of the thing I said was that we would get into a situation where the dollar and gold were rising together. I've always been a huge believer of gold. I think gold is probably the most important asset in my portfolio. And my thing into a situation where all fiat currency is debased as government deal with these current crises. But for reasons that I've many times, the dollar is, will outlast all of the others. So if you chart the gold and all the currencies, the two top would be the dollar and gold, right? And there may be a period of time where gold is underperforming the dollar, but in general, I expect gold to, my long-term price target for gold has been $5,000, right? I still think we'll eventually get there, I don't think it's going there tomorrow, but I think long-term, that's where it's headed. And I think the dollar will rise versus all the other currencies. And so I think if you chart all the currencies on a graph, that's exactly what you'll see. You'll see the dollar outperforming all the other fiat, and you'll see gold outperforming everything from a currency perspective.
And U.S. stocks outperforming almost all other stocks.
Yeah, exactly. And it's really not even close. Again, it's kind of the only game in town, and people will often then say, "Well, this is just the cleanest, the cleanest dirty shirt in the hamper." And my response is always, would you rather wear the dirtiest dirty shirt I mean, yeah, I get it. It is the cleanest dirty shirt, but which one would you prefer? I mean, if you really want to wear the one that's really stinky and really dirty, then be my guest, but I'd prefer to wear the cleanest one.
Yeah, I think of people who say the dollar is the cleanest shirt in the laundry as people who generally agree with you.
But here's the other thing too, and this is really important to understand, especially for, listeners who are perhaps not versed in finance and, haven't been on Wall Street for 40 years and may perhaps don't understand all the lingo. And they're kind of, actually, I should take a step back because even people that have been on Wall Street for 40 years often get this really messed up. But
yeah, people who may not, they may not even have a podcast, Brent.
No, exactly. But the idea gets put to me all the time that the DXY doesn't matter because all fiat's getting debased. And therefore, it doesn't matter whether the dollar rises versus foreign currencies or not. That is probably the biggest misconception that I can think of. And if I could dispel one myth today, it would be that. Very few things in global finance matter more than the relative level of the dollar versus another currency. Because when a dollar rises versus other currencies, it puts an incredible amount of pressure on those countries and those economies and the debts that they have, and including the United States. But what causes crises, what causes liquidity events is when the dollar rises, or whether the dollar rising causes it or whether the dollar rises in reaction to it. I think that's kind of open to interpretation. But when the dollar rises versus other currencies, really bad things happen because that's what forces liquidations. And when liquidations start in a debt-based monetary system where credit has to expand or it crashes, that's what leads to crashes. And all you have to do is get a chart of the DXY and go back 25, 30 years. Every time we've had a global slowdown, every time we've had a crisis, 100% of the time it has coincided with the dollar rising versus other foreign currencies. Now, if you are convinced it's going to be different this time, then be my guest. Bet your whole portfolio that way. I would strongly recommend against it because, again, it's probably not different this time. The reason the dollar has risen during all those previous crises is because that's what the system demands. That's the way the system is designed. And so to think that isn't going to happen again, to me, is quite a leap. And that is why fiat versus fiat matters.
I know what you said is empirically true. It's very interesting to me as a debate about why it's true, why the dollar squeezes when there's a global recession, a global crisis, given that the rest of the world is a net creditor to the U.S. In other words, the U.S. should need the other world's dollars, not the way around. But I think it's that even though the rest of the world sends more money to the US than the US finances the rest of the world, the liquidity dependent financing that's like more short term is a lot more dollar based. At least that's one theory that a leading scholar, Bob McCauley from formerly of the BIS, said to me in an interview. But regardless of why it's the case, yeah, what you said is empirically true. During crises, there is a dollar squeeze. So Brent, I understand in a gently rising dollar, such as we've had recently, the market can go up. But explain how, are you saying that during a true dollar squeeze, the U.S. market will go up? Because when I think of global financial crisis, March 2020 and 2008, those aren't environments where where the U.S. stock market does well. It might do well than its peers, but it still sells off.
Well, I think what is ultimately going to happen, and again, I'm going to say this because I have been accused of changing my story.
Have you? I wasn't aware of that. What do people accuse you of?
People will say that I never said bonds were going to fall. Many people think that I'm a treasury bull. I'm actually not a treasury bull. People will say that I never said that gold would go higher. So I'll refer back to the very first time I ever spoke about this publicly. One of the key points was that interest rates would rise and bond prices would fall. So I am actually not a long-term treasury bull. I understand completely how it's possible that they will rally and perhaps interest rates will go back to zero. I can't rule that out. In some kind of a massively deflationary scenario, that would make a lot of sense. But the way that I think we get into a situation where the dollar rises significantly and U.S. equities rise significantly is because I think we have reached a point in global debt where debt is going to start to be repudiated, including US Treasuries. Now, I want to be clear here. I still think the rest of the world will buy Treasuries more than they will buy US Treasuries, more than they will buy other countries' Treasuries. But they may prefer other asset classes to Treasuries in general. As money flows out of bonds, especially other countries' sovereign bonds, I think one of the places it will find a home is in US equities. And to a certain extent, I think we're already seeing that. Again, just go back and look at the flows into the United States and what they're going into. Some of it's going into Treasuries, not as much as it used to, but it's also going into US equities. That's part of the reason that US equities have done so well over the last 3 or 4 years. Now, I've said there's going to be terrifying drawdowns along the way. Perhaps we've just started one now. But when that abates, I would expect those flows to keep coming back, because where else are they going to go? Again, are you going to buy either the Treasuries or the equities of an emerging market who has less liquidity than the United States? Again, maybe you are, but I believe capital will continue to flow to the United States. And if you think about all the money that's in fixed income, and we get into a situation where yields are now permanently higher or potentially going higher, especially in countries or economies that aren't as liquid and not as favorable as the United States. If money starts to leave all those fixed income markets, where is it going to go? Now, I know some people are going to say it's going to go into gold. I agree. Gold's probably going to go a lot higher, right? But it's not all going to go into gold. It's not all going to go into Bitcoin. Some of it, I think, is going to go into U.S. large cap equities. I think in many ways, U.S. large cap equities will become the new Treasuries. And I think when that happens, as capital flows into the United States, what's the first thing? If you have foreign capital and you want to invest in the United States, what's the first thing you have to buy? Well, the first thing you have to buy is dollars, because you can't buy Apple with yen. You can't buy Apple with rubles. You can't buy Coca-Cola with lira. So the first thing they have to buy is dollar. So they buy the dollar, and then they use those dollars to go buy U.S. assets. And so that is the method via which I think at the end of this big crescendo of liquidity, we'll get this huge blow off top. Dollar goes higher, U.S. equities go higher, gold goes with it. Yields are probably much higher than they are. Many economies around the world are melting down, and all the liquidity in the world gets squeezed into the United States. And then that will bust, and then we'll have to go on to some new trade. But I think that's still several years away.
And thank you for that. And what are the implications of a strong dollar? So it can cause a slowdown, a credit contraction in the rest of the world, but it is good for other countries' exports. For example, the Japanese industries that Uniqlo, they're making, I think they make it a lot in the rest of Asia, not Japan. But let's say Uniqlo, they make it in Japan, they pay everything in yen, which is a very cheap currency, and they sell it in dollars, expensive currency. That's a great trade. Isn't that stimulative? Isn't a strong dollar stimulative for the rest of the world in that way? And net negative for dollar-denominated companies or U.S.-based companies. I think of Netflix in 2022. We had the strong dollar. They're paying everyone in dollars in Hollywood, and people in Brazil and Norway are paying for it in their currencies, which are going down. That's bad. Netflix lost money doing that. What about that channel?
Here's the interesting thing. Part of the reason that the rest of the world suffers when the dollar gets stronger is that the rest of the world owes just as much in dollar terms as the US does. I mean, I think a lot of people know that the US owes 35 trillion now, right? Well, if you add up all the debt from the rest of the world in dollars, it's over 30 trillion as well. They can't print it. They have to go buy it on the open market. So as the dollar gets stronger, that debt is actually rising in terms of their local currency, right? So that's one of the reasons. So here's with what you're just talking about, in some ways, a stronger dollar does help them, because that means their currencies are weaker, as long as it's in moderation. The problem is when we get a surging dollar, or, again, if the dollar just kind of goes sideways and trends up a little bit, that's not necessarily a bad thing, because in that environment, credit can still get extended, trade can still take place, cheaper goods from other countries flow into the United States. We can work with that. That's kind of what we've seen over the last couple of years. But we get into a situation where if the dollar starts to rise precipitously, whether it's 5 or 10%, that starts to put real pressure on these economies. Even though their currency is getting weaker and it should make their goods more affordable, it's putting an incredible amount of pressure on the debt that they owe. And here is one of the key things to understand about financial repression is that the rest of the world cannot financially repress their economies to the same efficiency or with the same efficiency as the United States. And the reason is because they're damned if they do or damned if they don't from a currency perspective. If the rest of the world were to do QE in order to stimulate a slowing economy, that weakens their currency. But then that makes the dollar stronger and it crushes them from a funding perspective. Conversely, if the dollar gets weaker and their currency rises, then how can they financially repress if their currency is getting, how do they inflate away their debt if their currency is rising in value? So it's just a much more difficult time for the rest of the world than the United States. It doesn't mean that it's impossible. It doesn't mean that they can't do it. It's just that the rest of the world has an incredible amount of challenges that the United States doesn't. And that is literally the result of having the global reserve currency. That is the benefit of having it. And that's why, it's like the one ring in the Lord of the Rings. It's the ultimate power. That is global seigniorage. The ability to print money for free at no cost to yourself, that's global seigniorage. And that is the privilege of the global hegemon. Now that has negative, things as well, but that's the big advantage. And that is why the United States is in the position it's in, despite all the debt, despite the budget deficits, despite the trade deficits, despite all the newsletters that have been written since 1978 about the impending doom, that it just hasn't happened yet. Now, again, I'm not saying that it won't happen, but I'm explaining why it hasn't happened yet. If you look at all the disadvantages of the United States, there are several. If you look at all the problems, there are several. But if you look at the advantages that it has, and then you compare it with the same level of analysis to the rest of the world, the US just has a number of advantages the rest of the world just doesn't have. And on a relative basis, that's allowed them to keep going.
And Brent, earlier you said something, I think it's by far the most radical thing you said so far in this interview. I don't want to make sure, we don't skip past it. You said that you think debt will be repudiated, which really means default. How do you think that will happen, given that it's very rare? I think it's technically impossible for a country that owes debt in a money that it can print to be forced to default on that. It can default, and I think several Latin American countries have defaulted on debt that they owe in their own currency. And there was a worry, for example, last year with the debt ceiling, that if the US didn't extend the debt ceiling, certain short-term treasury bills wouldn't have been paid on time. They ultimately would have been paid back, but people would have missed out on their coupons. That's why you had a very strange, short-term treasury bill interest rate structure. But, okay, Argentina borrows in dollars. It's going to default on that. Of course, that happens all the time. But the US defaulting on its dollar-denominated debt, or for example, China, its debt is mostly denominated in yuan. China has a lot of debt issues, but I think a lot of the sovereign debt is denominated in local currency terms. Some countries is dollar denominated, and that they're screwed. I get it, but how do you see this repudiation? Because that to me seems quite severe.
No, you listen. You're hitting on a very key issue, and this goes back to part of one of the fundamental reasons that I've pounded the table on my views is that if the rest of the world local currency debt are going to have to probably print their currency or cap on yields, whether it's by QE, cap, or whatever it is. But then that is going to cause their currency to lose value versus the US dollar. And if their currency loses value versus the US dollar, then that's going to put incredible pressure on their economies, right? They still have to buy needed inputs, commodities, energy, whatever it is, and that's priced in dollars. If you have any doubts about this, just go back to 2022 when the DXY went to 114 and see what was happening around the rest of the world. So but this is also why I don't think this is all going to happen tomorrow. I think this is going to play out over a number of years. The first thing that countries will do is they'll try to cap yields. Again, whether it's by a QE or some kind of an interest rate cap or monetary policy, that's what they will try to do. But then the outlet becomes the currency, right? Mm-hmm. And then as the currency weakens, that will lead to other things. And as the currency weakens and their economy slow, then I think the capital, people that do have capital are going to send that to the United States, because if you can just sit in dollars and the local currency loses 5% or 10%, you make 5 or 10% just for sitting in the global reserve currency and doing nothing. And then if the US is paying 4 or 5% on its money, now all of a sudden you've got a 10 or 15% return, right? And then if you decide to buy some US equities that happen to go up 5 or 10%, now you've got a 22% return or whatever it is. But the point is this is the disadvantage that these other countries have. The other thing is, we went back, referring back to what we talked about earlier, if countries are going to put caps on their interest rates via some monetary policy, then how are they going to compete with the US Treasury that's yielding 5% or 6% or 7%? Again, it deprives them of the much needed liquidity that they need. And so it becomes this vicious cycle where dollar strength begets dollar strength. Capital flows into the United States beget more capital flows in the United States. As capital flows into the United States, it deprives liquidity to the rest of the world. As the rest of the world is deprived of liquidity, their economies turn down even more. As their economies turn down even more, there becomes even more demand to get into the United States. So it goes around and around and around. And I don't know, but I think when it finally gets away from the central banks, including the Fed, and they can no longer control it, that's when you get that crescendo higher, which will ultimately end, as I said, the very first sentence, the very first time I talked about this stuff, this will all end very, very badly. It just won't end yet.
Right. And the yield curve control you reference, it's only a handful of examples I can think of. Japan did yield curve control. Reserve Bank of Australia briefly attempted yield curve control. In the World War II, US did yield curve control. But it's I think it's fair to say it's quite uncommon, definitely an unconventional monetary policy tool. And oftentimes central banks do things, even like, let's say the Federal Reserve buys $1 trillion worth of bonds. People refer to that as yield curve control or quasi yield curve control, which it's literally not. I mean, it's literally not. Yield curve control is targeting a specific yield and printing as much money or burning as much money as, to use a crypto phrase, burning the token until it was within a certain band. And doing $1 trillion of quantitative easing or quantitative tightening it's not that. It just isn't. So when you say your repudiation, I think what you mean is kind of a soft default where it's defaulting via the currency weakening or inflation, which is different than a direct default. Is that correct?
Again, most countries will never choose to default on a currency that they can print. But when you remember that the rest of the world also owes tens of trillions in US dollars, I think it's very likely that those countries do default, right? And then people will say, yeah, but then that just all falls back on the Fed balance sheet and they'll have to just print the money. Okay, let's say that that's correct. They will be printing the money in reaction to a rapidly rising dollar. Because as those defaults happen, you get a credit contraction. And when you get a credit contraction, you get a contraction of supply of currency, of dollars. As the contraction of the dollar supply intensifies, the price rises. The price rising is what causes the Fed to go to QE. Again, I think sometimes people get the cause and effect messed up. They say the Fed prints money and therefore the dollar falls. No. The dollar rises and that's why they have to go, do QE. If you look back over the last 40 years at all the monetary policies that the Fed has done, the extraordinary monetary policies, the bailouts, the stimulus plans, the QEs, the Operation Twists, the Plaza Accord, the Louvre Accord, I think 1 out of 20 was designed to strengthen the dollar. All of the others have been done to weaken the dollar. Now, if the dollar is this failing currency that can't stand on its own 2 feet and is destined to end up in the ash heap, why in the heck does the Fed have to keep weakening it? Right?
Yeah.
Because the reason is because there is so much demand for dollars outside the United States that the US can, quote unquote, get away with profligate monetary policy and budgetary policy because there's so much demand for the dollar outside the United States. The reason the rest of the world can't get away with this to the same extent is they don't have the same external demand for their local currency that the United States does. Let me give you just a quick analogy.
Mhm.
I think a lot of people think of, the US dollar supply is like a swimming pool, and it's the swimming pool is full of water, and that's dollars. And when the Fed starts printing more money, they start pouring more money into the swimming pool. And before long, that swimming pool is going to fill up and it's going to overflow, and those dollars are going to flow over the yard and out into the street. And that's all this excess liquidity, and that's all this inflationary pressure, and that causes the dollar to lose value. That's not necessarily wrong, but what they're forgetting is that based on the design of the system, there's a drain at the bottom of the US dollar swimming pool. And that drains out into the rest of the world, which is an even bigger swimming pool, probably 10 times the size of the US swimming pool, called the euro dollar market. And there is so much demand in that euro dollar market that no matter how much money the Fed puts into the swimming pool, it just keeps draining out the bottom because the rest of the world is trying to get it. Now, imagine what happens if someone like Trump or JD Vance were to get into the White House, and now they put up tariffs. Now they say, you know what, we're fine helping out the rest of the world, but we're going to help ourselves first. And the way we're going to do that is we're going to swim down to the bottom of that swimming pool, and we're going to put a bunch of cement over that drain that sends dollars to the rest of the world. Now we're going to, if you're a local company, if you're a US company and you need funding, just come to the Fed. We stand ready to help you. But if you're a foreign manufacturer, if you're a foreign trading partner who thinks you're going to access our cheap financing and then turn around and sell your goods into the United States at a lower price than we can produce here, good luck. Now, what happens when they cut off that dollar supply to the rest of the world, and the rest of the world has to go buy dollars that are now rising because the supply's been cut off? What happens to those other countries' economies? So again, and again, if the rest of the world can all at once decide we are no longer going to use the dollar, all of the euro dollar debts are automatically transformed into this new thing, then potentially they could possibly work their way out of this. But if you've ever been in a meeting with more than 3 people, or if you've ever gone to a family dinner and tried to get everybody to agree, good luck. I think that would be characterized by great volatility. And as I said before, if you just look over the last 25 years, anytime there's been great volatility, there's been a rising dollar.
You're referring to something I haven't seen, but I definitely take your word for it, that the Trump and JD Vance want to cut off dollar funding to the rest of the world. But don't they also, in particular, JD Vance, want to weaken the dollar to strengthen exports and strengthen manufacturing?
Yes. And this is when I'll say, just because you hear a politician say something doesn't mean it's possible to actually do it, right? They will get up there and they'll say, we want to bring jobs back to the United States. We want to put up tariffs to the rest of the world. We also want to bring down inflation. Oh, and by the way, we want lower interest rates. Tariffs, if they lower interest rates, that will, to a certain extent, potentially offset the tariffs. But if they cut interest rates again, but the tariffs could offset the interest rate cuts as well, because you're restricting funding to the rest of the world. And so just because they want these things, it doesn't mean they can actually get them. Printing money, lowering interest rates, that doesn't necessarily help with inflation, which is one of the things that Vance and Trump say that they want to attack. But what I think is very interesting is for many years now, 50, 60 years, we've had this US dollar market and euro dollar market in which the two were totally fungible. And as a result, they're priced, euro dollars are priced at par. They're worth 100 cents on the dollar for a US dollar. But no one in the euro dollar market can print base money. The only way they can create more euro dollars is by using their own balance sheet, risking their own balance sheet, and creating a new loan. The US is the only one who can create new US dollar base money. And then they can ship that outside the United States, in which it becomes euro dollar base money. But the euro dollar system cannot create it on its own. And so I think it's possible, as we move forward in time, as we get more nationalistic policies, which I think we are regardless of which administration gets in, as we get into a time of greater geopolitical conflict rather than less, I think this, this ability for euro dollars and US dollars to exchange immediately at par may be put to the test. And that in itself, I think would cause great volatility. And again, I go back to my 25-year chart. Times of great volatility lead to the US dollar rising.
Yes, I mean when par breaks, to use the Perry Merling's old time Pozar language, like if a bank deposit at Lehman Brothers is no longer worth a bank deposit at J.P. Morgan, that's when things
Exactly
get
right.
hairy in the financial world. I recently spoke with academic I respect greatly, Michael Pettis, who said that the reason that the U.S. government runs such a large fiscal deficit is not because we are so irresponsible, we love printing money, and China has this huge trade surplus because they're so thrifty and they're so hardworking. It literally is just mechanical. If China runs a very large trade surplus and the U.S. has a trade deficit, mechanically, what he was saying, and he knows a lot more about this than I do, that the U.S. either has to have high unemployment or run a large fiscal deficit to offset that. And therefore, the choice is easy. Run a large fiscal deficit. We can't have 13% unemployment, especially if you're a politician. What do you think about that theory? And if we're going into a world where, regardless of who gets reelected president, regardless of which party wins Congress, you said nationalistic policy. Let's call it policy that is deglobalization, and it's built in America. So it's higher tariffs, and it's getting out of trade agreements where, as Trump would say, China can rip us off. I don't think I would use that language. But regardless of, and Biden has put tariffs up or not taking tariffs down. So the era of globalization, let's build everything in Vietnam, like that's over. How does that impact the global dollar system and the financial system that we've been talking about?
No, I think it perfectly aligns with it. And I listened to your interview with Pettis, and I think he's largely correct. I mean, it's literally just a numbers game. I mean, that is the way the system works. Again, as we move forward in time, my guess, and I think I don't think I'm way out on a limb by saying this. I think we are moving into a time that is less cooperative on a global stage than it has been. I think we're moving into a time where cooperation between countries is going to come with certain strings that didn't come before, regardless of whether the Republicans or Democrats are in the driver's seat for the next presidential administration. I think more protectionist policies will take place than we've seen over the last 20, 30 years. And as a result of all of those, I think dollar supply will be less plentiful than it has been over the last 20 or 30 years. But all of that US dollar debt still exists. And therefore, all of that US dollar demand still exists. And when you have the same level of demand with falling supply, what happens to price? Price rises. So I think it is not impossible for the dollar to fall. I just think it's very unlikely. And if it does fall, I think all that does is it encourages more borrowing in US dollars, kicks the can down the road, and we end up right back where we are 2 or 3 years down the road. And the other thing, we haven't really talked about this, Jack, but all of these advantages that I've said the US has and the US doesn't, it also gives the United States the ability, if they choose to use the dollar as a weapon. And that's exactly what we saw in 2022. Sure, the interest rate hikes were intended to slow the economy and get inflation under control. Absolutely. But there's also a secondary effect, and that is to put the rest of the world under extreme pressure. And all you have to do is go back to 2022 and see it. I was talking to people in positions of power and policy making in DC in the summer and fall of 2022, and they were, they were getting calls from all over the world saying, "What in the hell is Powell and Yellen doing? They are killing us," right? But in many ways, that was the U.S. saying, we're still the hegemon. If we so choose, all we have to do is push this button, and your economy comes under extreme pressure. Oh, and by the way, we've got these, two economies that are kind of rivals of ours, Russia and China, and they're kind of aligning and they're forcing people to pick sides. And so, if we're picking sides, by the way, which side are you on as your economy continues to fall and your currency continues to crumble and you're having trouble getting US dollar financing? And then, it basically, it's a way of, what's the right way to say it? You make people choose sides. You can put them under pressure. If you can put somebody under pressure, you can get them to do what you want them to do easier than if they're not under pressure. And if you really want to stick it to them, you can cut them off from complete dollar supply. And again, I know people say, well, it didn't hurt Russia. Well, you know what?
Yeah,
Not everybody is Russia. And listen, Russia has done well over the last couple of years, but they haven't done everything perfectly. It's not like things are rosy over there. People say, oh, you go to Moscow, the restaurants are full and the taxi cabs, there's a line to get in taxi cabs and everybody's happy. Okay, sure. I'm not saying that doesn't exist, but the Russian government started running a budget deficit for the first time in a long time. They had to change the way that they taxed their energy companies and get more taxes out of them because of this budget deficit. So not everything is perfect. Not only that, but recently there was an article about the Russians who were selling things in yuan. Now they have all this yuan they can't use. When they were selling it in rupees, they have all these rupees they can't use. And so, while they have survived, they haven't figured out a final solution that fixes all their challenges. And in the meanwhile, the U.S. has been securing its allies as well. And so, but I think this is going to continue, Jack. I think these lines are being drawn, sides are being chosen. And, the next time there's a global crisis, I don't think the Fed will be as eager to hand out dollar liquidity to a country or an economy that is not aligned, quote unquote, geopolitically with the United States.
Yes, I think it's fair to say, Brent, that Russia, relative to the wildly bearish expectations of when Russia first invaded Ukraine, the expectations were that their economy would shrink by 20%, the ruble would collapse, and the ruble did collapse for a very brief amount of time. The unemployment rate would surge, they'd have an economic collapse. That hasn't happened. Inflation went as high as 15%. The ruble collapsed and then restored its value, although it has been weakening. And real GDP for 2022, it was negative. Definitely a horrible year under a non-border war, but definitely better than expectation. But I just think it goes to show that the economy is not always the quality of human life. I think that it's just a brutal, horrible war. But yeah, the financial system of Russia has not collapsed by nearly as much as I think the median expectation was, and definitely the most bearish expectations were in 2022. But I think I don't really know, but I suspect Russia is doing something to keep the plate spinning, and some people will really for some reason feel very negative if I say this, but I think Russia could be selling its gold, and maybe that's why gold was performing so poorly up until recently.
Is very possible. Again, if you get into a gold standard and you need something, what do? You sell your gold.
Yeah. And when China buys gold, they announce it. But when Russia sells gold, they don't have to announce it. And,
Well, the only thing with regard to this topic, Jack, all you have to know is every time Japan or China and Russia do something, it's a 3D chess move. And every time the United States does something, it's checkers. They're infinitely smarter than the United States. They can't do anything wrong. And the U.S. is just, I'm being sarcastic here in case people can't tell.
I think that's absolutely right. And so I've seen you talk about this, Brent, about how using the dollar as a weapon, and the U.S. has used the dollar as a weapon, you could say successfully, against Iran, against Venezuela, against countries that are much smaller. But when it comes to going against Russia and particularly China, do you not think it would be a mistake to use the dollar as a weapon? Because, and I'll say what I agree with you on most things, is that I think the global dollar system is stable and will last a lot longer than a lot of people expect, and that we get kind of an advantage. We get to print money that then we get to exchange things for goods that other countries produce. But the factory of the world, maybe not in AI, but in a lot of electric vehicles as well as so many other stuff, is in China. And don't you think that would put the global dollar system at risk? Because if Russia can figure a way to function, I think China probably could too.
Well, I think what I would say is, if China decides to abandon the dollar system and Russia decides to abandon the dollar system, they can do that, and they can become less global rather than more global. And the outlet there will be their currencies. China has enormous problems right now. Their stock market is down tremendously. They have some social unrest that Xi has had to deal with. Their real estate market has gotten absolutely crushed. Their banking system is doing everything it can to deal with the bad loans on its balance sheet. And what eventually ends up happening is the release valve for those kinds of problems ends up being the currency. Sure, they can kind of shut themselves off from much of the world. And, and here's the thing is, I think a lot of people don't realize this. This is largely what Z has been doing. Z has been kind of pulling back from engaging with the rest of the world. He's been putting policies. He's been kind of, in a certain way, doing the make China great again, or now, whatever you want. He's doing many of the things that Trump is proposing doing. And he's been doing them for longer than Trump has been doing them. So, when people say that the US is thinking about pulling back from being the global hegemon and they're going to focus more domestically, this isn't just a one-sided thing. China's doing it too. Russia's doing it too. And this puts the rest of the world in a tough spot. Who are we going to do business with? How are we going to do business? Who are we going to align with? And all of this causes uncertainty. All of this causes friction. All of this causes less liquidity than otherwise would be. And generally, in a world with greater uncertainty and less liquidity, bad things tend to happen. So I'm not smart enough to know exactly who's going to do what. I'm not smart enough to know who's going to, do this one thing right, or this policy is going to work perfectly. But what I do think is going to happen is greater uncertainty and greater volatility. And again, as I go back to my thesis, I think in that environment, the dollar beats other currencies. And when dollar beats other currencies, there's a number of historical examples that you can look at to see kind of how to play that.
Well, Brent, I really enjoyed our full conversation about the dollar. I think we've gone very in depth, which is very good. It's such a fascinating topic. I mean, you could say it really is the most fascinating topic. My final question for you is less bird's eye view, more to the nitty gritty with what people in the markets are dealing with today, particularly in the economy. You said that we could have a month drawdown, a 6 month drawdown, but that ultimately you expect the U.S. stock market to go to all-time highs. Are you in the camp that the U.S. economy is going into recession? That is a view that people have had since really late 2021 that has not played out. However, the data today, maybe it's not as bad as people in the market are pricing in 2 double cuts by the Fed, but it is quite bad. So what is your economic view about whether the U.S. is going to go into a recession with an capital R, and that is to say an official NBER declared recession, or might already be in one?
So in general, I'm not in the recession camp.
Okay.
But I think if we do have one, it would be kind of like the one we had in 2022, where markets pulled down and then we kind of had this V-shaped run out of it. It's funny because we had the V-shaped run in 2020. We had the V-shaped run in 2022. I think we're at a point where it becomes harder to extend this overall game than it has over the last 20 or 30 years. And as a result, I think things will move quicker than they typically do. I still think they're going to take longer to play out than most people, but I do also think that the speed with which things happen will increase. And so my base case is that we probably will get a lot of volatility, perhaps another hard drawdown sometime over the next 6 months. And then I think we would come out of it, perhaps similarly to what we did in 2022. I'm not in the camp that says, we are now at a historical high, something like 1929. We're due for a 70 or 80% correction, and it's going to take us 15 or 20 years to crawl out of it. I think I think that's possible, but I don't think that happens for another several years. Again, can I be wrong? I can absolutely be wrong. I think you need to be prepared for all scenarios, but as of right now, I'm not in a lingering recession camp right now.
You're not in a deep recession camp. And in 2022, right, the NBER did not declare a recession. I think economists now view that as a mid-cycle slowdown in real, that is to say, inflation-adjusted growth, because inflation was so high and the price of oil went so high. But that was not a recession. And so that sounds like if you think there's going to be a slowdown, you think it's somewhat unlikely that it will be a NBER declared actual serious recession. But a mid-cycle slowdown is always possible. Brent, thanks so much for coming on. People could find you on Twitter at Santiago AU Fund. Thanks again. I'm glad your internet connection worked out, and thanks everyone for watching.
All right, thanks for having me. Have a great weekend.
You too. Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.